Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The environment. This was that move, just that massive power move down when the U.S. was pushing out all that dollar-based credit in the world. As I said, during this period, the Canadian yield spread actually went under the U.S. yield spreads for that 10-year note, that 2-year note, but it didn't matter because the U.S. was pumping out so much dollar-based credit in a form of derivatives that it was just a power move of putting more and more supply of dollars offshore. So we have to understand the environment you're in a bit too, but that helps. Also, the environment. Powerful move in stocks, emerging market stocks I have here as a risk asset class, powerful move in commodities, a break on the credit crunch hit. Credit crunch, let me get rid of some of this, sorry. Getting a little crazy with my pencil. Credit crunch hit right in here, and sure enough, as we know the story, commodities down, stocks down, the dollar got a big boost. So we're in that environment again. It's making sense. Stocks are moving. Commodities are moving. We're in a risk appetite environment. It's supporting the risk appetite currencies. Australian dollar, Canadian dollar. The trend is powerful. The yield spreads are starting to rise in those currencies. All this stuff is starting to validate each other, which makes it, again, when you start to line up all these things together, it makes the probability of the trend look stronger. Do we know when it's going to turn? Absolutely not. Could it turn quickly? Yes. But in general, these are some nuances that you can add to your pure price model, and that's the only point I really wanted to make here. One more thing, and I'll turn it over to Steve. A little windy here, I'm sorry. This is a little bit of a chart we put together, and we kind of just think of this as, again, qualitatively when we think about this, although we check the spreads. In terms of the trend leaders, these are most powerful 1, 2, 3, 4, 5, 6 in terms of the U.S. dollar. Aussies first, Canadian, yen. Canadian yen, maybe this is reversed, maybe yen. Euros fifth, pound 6. Pound is really lagging everybody in here. Yield advantage, big yield advantage in Australian dollar. As I said, slight advantage in Canadian dollar. You got a negative yield in the yen, maybe very, very short-term time frame. The dollar is slightly lower, but in general, across the curve, interest rate curve, the yen is negative compared to the dollar. Same with the Swiss. Euro slightly positive on the short end of the curve, longer end, the U.S. dollar. Treasuries have a better yield, and that's why I think the Treasury is supported. But stick with me here, and I'll get to the point. British pound, again, slight small yield advantage, and it's lagging. The environment, risky appetite, supporting these guys. They have yield advantage. Again, ticking those off qualitatively makes sense. The environment is not supporting the Japanese yen. We just don't see it as any support for the yen in terms of their economy. It's kind of a neutral against the European currencies. So the environment's suggesting why these three things should be lagging, and we're seeing it on the price action. Swiss starting to catch up a bit and a little bit out of trend move. But the yen to us, a negative yield, the environment is not necessarily a good environment for the yen or supportive for the yen. So to us, this is a trade that sticks out to us that as soon as the trend starts to turn and we see some type of crossover, just based on this qualitative chart we put together, really to us is the play back the other way should the dollar ever start to bounce and start to move. So again, this is something you can put together qualitatively to really add some nuance to the model, so when your model does start to move and pull back, which of these currencies would be the best to play if the dollar starts to rally. And to us, at the moment, the yen is way overdone. So that's an example of how we add some nuance to the trend trading stuff. Over to you, Steve.
Thanks, Jack. As always, I'm getting some great comments from the attendees, so thanks again. Your material is very, very insightful. Thanks.
Thank you.
And we're going to turn it back to you just one brief moment, Jack. But I just want to go through, because I've had a couple questions about the bid-ask spreads, are they reasonable, volume. So I took some screenshots of the markets just about an hour and a half ago. And here's the U.S. dollar against the Australian. I looked at the December options, and with the AUX, with the dollar Australian trading around 110.35, you'll notice that the DEC 110, so we're out a couple months, are worth about 390s or so. And when I say they're worth about, I'm looking at the call. What are they worth? Well, it's the mean between the bid and the offer. And the other question, so that is that reasonable? Well, it's a 30-cent wide quote. So as Jack was pointing out, probably not a great, this product is not going to be something you would be trading intraday, because you'd be giving up 30 cents for each trade that you put on. But if you were looking out over a 2-month time frame, well, 30 cents is not unreasonable. And that, if you're looking at that, the DEC 110 call, let me see if I can highlight that. Grab this back. The DEC 110 call, well, that's, I'm looking at this option here. That's the call option, and that will benefit if the dollar rallies, if and when, of course, we've seen the trend going the other way. If you believe that the trend was going to continue as it is, well, you might look at the 110 puts, because if the dollar breaks through 110, well, you have the right to sell the U.S. dollar. Remember, this is in terms of the U.S. dollar. So if we continue to see this trend, well, this market of 212 bid at 230, you might want to look at that to implement a bearish forecast on the U.S. dollar. So you'd be looking at call options. So these options here, call options, if you're bullish, and if you're bearish, if you thought the market was going down, you'd be looking at put options. So bearish over here, I'll just say this is plus, and again, these would be minus. These are put options. The other point I wanted to make is that I had a question from Mary, and Mary's question was, how do I know how much the option will move if the underlier moves? Well, that's what's called delta. So you'll notice that the DEC 106 calls have the highest delta of about 74, and that means that for every dollar that the U.S. dollar rallies against the Australian, let's say we go to 111.35 tomorrow, well, that call should move up about 74 cents. However, if the dollar goes down tomorrow by $1, well, then that option will go down by about 74 cents. And you could use the same logic in the puts. So there, the put would have about a 23 or 24 delta. So this is dollar versus Canadian dollar. I'm sorry, dollar versus Australian dollar, trading 110.35. And you could go through the chain and say, well, the most expensive options are going to be the in-the-money options. For the calls, it would be here. For puts, it would be the reverse. So the higher strike puts would be the highest price. So if you thought that the dollar was going to continue to fall and you want to create a product or create an option or buy an option that was going to act a lot like being short the U.S. dollar, you might buy a put option. So that's the U.S. dollar against the Australian, and the symbol there is AUX.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.